It is all about yields right now, 4.3% on a 10-year yield in the United States. As we were talking, Gregory Staples of DWS and Stephanie Roth of JPMorgan, we've been talking about could they get up to 3.5% a couple of months ago, even a month ago, and yet here we are. Gregory, what do you make of the move that we're seeing today?
You know what? I think what's been going on is that the markets really had a sea change in their perception of what the Fed's going to do. If you go back to the summertime, there was real skepticism and a sense that a pivot was going to come fairly soon. And the Fed speakers pushed back against that fairly hard, and now the markets embrace the tightening with an evangelical passion. The market's almost ahead of the Fed now, pricing in 5% by the first quarter of next year, and you're seeing that reflected across the curve, and now for the first time it's really starting to impact the long end. Are we close to the end? I don't know, but boy, oh boy, we've come a long way in a very short period of time.
Stephanie, what's your view here, especially as we see the pace of the move this morning? We've retraced from some of the highs, but still at the highest levels in the 10-year Treasury going back to 2007.
Totally agree with Greg in that it was driven initially by the economy holding up better than expected, inflation remaining higher. But more recently, the move seems to be less fundamentally driven. It appears to be more about illiquidity. And that could mean that the 10-year could back up even higher than where we are today. But we do think eventually rates should rally. And we do think that on the back of recession fears and recession actually playing out in the middle of 2023, rates should rally. It's just a question of how high does the 10-year get before that happens.
Well, and this to me really goes to the question that a lot of people are asking, Stephanie. Bank of America's Mark Cabana warning of Treasury market dysfunction, exactly kind of what you're referencing, writing, quote, U.S. Treasury liquidity has deteriorated amid weak demand and investor risk aversion. The market is fragile and vulnerable to shock. A Treasury breakdown is not our base case, but it is a building tail risk. As Stephanie, as you put it, is it a tail risk or is it actually a tailwind potentially giving to a rally with some sort of, I don't want to say pivot, but a sense that this cannot go on forever?
Totally can't go on forever. That said, the Fed's not likely to step in at this point, so this could get worse before it gets better. Eventually, we would expect that the Fed would step in the event of it becoming dysfunctional, but we're not at a dysfunctional point at this juncture. So it could continue for some time before the markets settle down.